In May 2002, an internal auditor at WorldCom named Cynthia Cooper pulled a general ledger entry labeled prepaid capacity and could not find a supporting document. The number was $500 million. It had been transferred out of an operating expense account and into a fixed asset account with no invoice, no vendor, and no depreciation schedule that made sense against it. She kept pulling. According to her later testimony before Congress, she ran the queries at night so the finance department would not see the system load and ask what internal audit was doing in the capital accounts. The question that closed the case was not whether the entry was fraudulent. It was simpler than that. Why would a company move a routine, recurring cost into an asset account? And why would that single accounting choice, repeated across 5 quarters, be enough to inflate the earnings of the second largest long-distance carrier in the United States by billions of dollars? The mechanism at the center of the WorldCom fraud is the distinction between an operating expense and a capital expenditure. It is one of the most basic distinctions in accounting, and that is precisely why it worked. An operating expense is a cost consumed in the current period. When a company pays for it, the full amount hits the income statement immediately and reduces that period's earnings. A capital expenditure is different. It is spending on an asset expected to generate value over multiple years, a building, a network, a piece of equipment. Under accrual accounting, that cost is not expensed all at once. It's placed on the balance sheet as an asset and then depreciated, written down in small pieces over the asset's useful life. $1 billion of capital spending on a network with a 20-year life might reduce this year's earnings by only $50 million. The category into which a cost falls is supposed to be determined by the economic nature of the cost, not by its effect on reported profit. The rule exists to match expenses to the periods in which they produce revenue. The specific cost at issue was what WorldCom called line costs. These were the fees WorldCom paid to other telecommunications carriers for the right to route calls across networks it did not own. According to the SEC's complaint, line costs were WorldCom's single largest expense, running to billions of dollars per quarter. They were unambiguously operating expenses. They were recurring payments for capacity used in the current period. There was no asset. There was nothing to depreciate. The company was renting access and consuming that access immediately. That is the baseline. Line costs were a current period cost, and every prior period at WorldCom had treated them that way. The architecture of the fraud was a sequence of journal entries executed after the close of each quarter that reclassified line costs as capital expenditures. The SEC's enforcement record establishes the timeline. Through the late 1990s, WorldCom grew by acquisition, most notably its 1998 merger with MCI. Its stock price depended on continued revenue growth and on maintaining a specific financial ratio that analysts watched closely, the line cost expense to revenue ratio. The market expected that ratio to hold at roughly 42%. When telecommunications demand softened in 2000 and 2001, the actual ratio began to climb. Line costs were consuming a larger share of revenue than the company had told the market to expect. The company had 2 honest options: report the deteriorating ratio and accept the effect on the stock, or reduce the costs. According to the SEC, it chose a third path. Step 1. At the close of the quarter, senior financial management determined the earnings figure needed to meet expectations. According to the SEC complaint, This was worked backward from a target. The number required to hit the target was the number that had to be produced. Step 2. The gap between actual earnings and the target was filled by identifying a portion of line costs and moving it, by journal entry, out of the expense accounts. The record establishes that beginning in the first quarter of 2001, WorldCom transferred line costs into property, plant and equipment accounts, treating them as capital assets. Step 3. Because the reclassified costs now sat on the balance sheet as assets rather than on the income statement as expenses, current period earnings rose by the full transferred amount, minus a small amount of depreciation. The SEC found that the company capitalized approximately $3.8 billion in line costs across 2001 and the first quarter of 2002. Of that, roughly $3.06 billion was moved during 2001 and an additional $797 million in the first quarter of 2002. Consider what this does structurally. A dollar of line cost correctly booked reduces earnings by $1 this quarter. That same dollar moved to a fixed asset account depreciated over, say, 20 years, reduces earnings by only about 5 cents this quarter. The other 95 cents does not disappear from the accounts. It is parked on the balance sheet, waiting to be released slowly through future depreciation. The fraud was not the creation of fake money. It was the relocation of a real cost from the period where it belonged into future periods where it would be diluted. There is a second layer the record documents. Before the line cost reclassifications began, WorldCom had also been drawing down accrual reserves, releasing previously established liabilities back into income to boost earnings. When those reserves were exhausted, the record shows the company shifted to the line cost method. The reserve releases had a natural ceiling. Once a reserve is drawn to zero, there's nothing left to release. The line cost capitalization had no such ceiling because line costs were an enormous recurring expense. Every quarter produced a fresh multi-billion-dollar pool of costs from which a slice could be reclassified. That is why the entries Cynthia Cooper found had no invoice, no vendor, and no depreciation schedule that made sense. There was no underlying asset. The prepaid capacity label described nothing that existed. It was a name attached to a journal entry whose only function was to move a number from one side of the ledger to the other. The detection failure is where this case becomes structurally instructive, because the fraud was not hidden in a complex derivative or an offshore entity. It was hidden in plain sight, inside the largest expense line of a widely followed public company audited by a major firm. The external auditor was Arthur Andersen. The question is how billions of dollars in misclassified costs passed external audit across multiple quarters. Part of the answer is structural. An external audit is a sampling exercise, not a full re-performance of the client's books. Auditors test balances against thresholds of materiality and assess risk to decide where to look. The record and subsequent analysis indicate that Andersen did not treat line cost capitalization as a high-risk area and, critically, did not obtain the general ledger detail that would have exposed the topside journal entries. The reclassifications were made at the corporate consolidation level above the operating units. They did not appear in the divisional books that field auditors would typically examine. They existed in the consolidation layer, where a small number of people had access. For detection to occur through the external audit, the auditor would have had to request and reconcile the topside entries against supporting documentation. When internal audit finally did exactly that, the fraud collapsed almost immediately. The entries had no support. The verification that would have caught it was not technically difficult. It was a matter of asking the general ledger where a specific number came from. There is a second failure in the analyst and ratings chain. The market watched the line cost to revenue ratio obsessively, and that ratio was the very thing the fraud was engineered to protect. Analysts saw a company holding its cost ratio steady while competitors deteriorated in the same softening market. The stability that should have prompted scrutiny was instead read as operational strength. The metric everyone trusted was the metric being manufactured. The internal control failure completes the picture. The reclassification entries required only that a small group with access to the consolidation accounts direct that they be made. According to accounts entered into the congressional record, junior accountants who executed or questioned the entries were told to make them without written justification. There was no control that required an entry of that size to carry documentation independent of the person ordering it. The segregation that would have forced an independent check did not exist at the level where the entries were made. For detection to have come earlier, one of three things would have had to be true. The auditor obtains the topside ledger detail. The analysts treat the suspiciously stable ratio as a red flag rather than a strength, or an internal control forces documentation on large consolidation entries. None held. Internal audit, operating outside its normal remit, supplied the missing verification. The unravelling began with the entry Cynthia Cooper could not source. According to her testimony and the SEC record, internal audit had been examining capital expenditures when it encountered the prepaid capacity transfers. Cooper's team expanded the review, working through the general ledger to trace the entries back to any supporting documentation. There was none. The sequence then moved quickly. In June 2002, internal audit brought its findings to the audit committee of WorldCom's board. The record establishes that the controller acknowledged the entries had been made and could not point to accounting support for capitalizing the line costs. On June 25, 2002, WorldCom publicly announced that it had improperly transferred approximately $3.8 billion in line costs, that its financial statements for 2001 and the first quarter of 2002 would have to be restated, and that the earnings it had reported for those periods were materially overstated. Absent the reclassifications, the company had not been profitable in those periods at all. It had been losing money. The SEC filed a civil enforcement action the following day, June 26, 2002. The subsequent internal and bankruptcy investigations expanded the total accounting misstatement well beyond the initial figure, ultimately identifying an overstatement of assets that the record placed at approximately $11 billion when all of the accounting manipulations were tallied. On July 21, 2002, WorldCom filed for bankruptcy protection. It was at the time the largest corporate bankruptcy in United States history. The mechanism collapsed the moment it was exposed because it depended entirely on the absence of a question. The entries had no defense. There was no argument that line costs were properly capital assets. Once someone traced a single entry to its non-existent source, the entire structure resolved into what it was: a recurring operating expense that had been relabeled to move earnings between periods. What the WorldCom case establishes structurally is that the most consequential financial frauds are not always the most sophisticated. This one turned on the oldest distinction in accrual accounting: the line between an expense and an asset. And it succeeded not because the manipulation was clever, but because the verification chain never asked the ledger a direct question about a specific large entry. The regulatory response was direct. WorldCom, together with Enron before it, produced the Sarbanes-Oxley Act of 2002. Section 302 required senior executives to personally certify the accuracy of financial statements, attaching individual accountability to the certification. Section 404 required management to assess and auditors to attest to the effectiveness of internal control over financial reporting. That provision speaks directly to the WorldCom failure. The topside journal entry that no control required to be documented is exactly the kind of gap Section 404 was written to force companies to identify and remediate. The finding is narrow, and it is sufficient. A cost is a cost in the period it is incurred. When the answer to "where did this number come from" is a label rather than a document, the classification is not an accounting judgment. It is the fraud itself.